Hey bud, a little sleepy. All right. How can you determine a quality project from a scam or a project that's just overhyped? And what metrics can you use to evaluate a project? And how can you see through the noise and the nonsense? These are questions that we're going to answer in today's episode of DeFi Now. Watch this video all the way to the end, and I'll share with you some red flags to watch out for that can save you from getting totally wrecked. Welcome to DeFi Now. I'm Josh Cross here with Steve Irwin, the sleepy DeFi dog. When you start down the rabbit hole of cryptocurrencies, you're going to quickly find out that this industry is crazy. It's crazy enough to scare away J.K. Rowling within a couple hours, even with Elon Musk's help. So how do you navigate the space and avoid the pitfalls, many of which I first fell into when I jumped in, while still finding quality projects while they're still small? After all, this industry is still highly speculative and most people are in it to make money. Without a foundational understanding, you're very likely to buy into a coin after it has skyrocketed in value because you think it's going to continue to go up. But then the price returns to the mean and you panic sell much lower than what you bought it at. So this is why we need to get educated about this. I'm going to go over 5 aspects of each project that you need to consider when doing your reconnaissance. These are the use case, the team, the feasibility of their goal, their tokenomics, and their community. Lastly, as I said, I'll go over some of the red flags that should immediately make you question whether to put your time or money into a given project. Without further ado, let's dive in. The first thing I think about when introduced to a project is its use case. What will this coin or token be used for? And why do they need to have a token at all? Why do they need to have a blockchain to record data instead of using a traditional database? Centralized databases are far more cost effective to run and maintain, so there needs to be a good reason why they're using a blockchain. Oh, you dropped your toy. Do you want it back? Okay, it's here. Are they just putting blockchain into their name to pump up the price like Long Blockchain, formerly known as Long Island Iced Tea? Or are they actually making it decentralized, open, censorship resistant? Some really good use cases include supply chains where multiple parties want to track the origin and movement of supplies, knowing it's much more difficult to fake it because it's on the blockchain. Decentralized insurance where you get paid out automatically when certain conditions are met without the bureaucratic nightmare of insurance nowadays. Or accounting, which is so painful now. So down the line we'll have all of our transactions recorded, taxes automatically calculated and paid, and instantly auditable without a middleman handling it. I'll dig deeper into blockchain use cases in another video. For now, let's move on to the team. The team is just as important as the use case, so we need to look at the size of the team, their history, their advisors. How transparent are they about the team? Is this the first time starting a tech company? Is the team actively engaging in the community and responding well to hard questions? Or are they banning those on social media who aren't fanboys? Do they have a legitimate LinkedIn profile and a public business address? Are they posting regular updates on Facebook, YouTube, GitHub? If you see irregularities or red flags, I urge you to use good sense and avoid the FOMO that comes when so many people are shouting about how great a project is. Starting a company is hard, but starting a decentralized company requires skills that only a handful of teams worldwide possess. This leads us into the next aspect of research: feasibility. Most businesses fail. This is true in the tech sector and even more so in the crypto sector. Does this project's success require some new innovation in order to succeed? It's easy to have a grand vision for a project. Hey bud. It's easy to have a grand vision of a project. It is orders of magnitude more difficult to successfully implement that vision and make it a reality. If a project isn't possible with our current technology, you can have a great team and they still may run out of funding before they can overcome that innovation gap. And everyone who bought their coin or token is left holding the bags. Tokenomics, or the economics of a coin or token, is a key indicator for the economic viability of a project. Things like inflation rate and total supply are programmed into the coin or token. So you need to ask, what is the current circulating supply? What is the total supply? What is the market cap? Or the current price multiplied by the circulating supply. It's a common misunderstanding for those who are new to this space to look at the price of a single coin and use that to determine what to buy. But this is misguided. You can have a coin worth $10 each and a circulating supply of 1 million, But that will be cheaper than a coin worth $1 each and a circulating supply of 1 billion, because you need to multiply the price by circulating supply to get the market cap. You comfy? Do you want down? All right. If you want to go lay down, here's your toy. Okay. In addition to this, it's also important to look at what percentage of the total tokens are controlled by the founders. If they own a significant amount of the tokens, that's a red flag, because even if the network is decentralized, they can still dump their coins on investors when the value goes up. The same is true if the founders have the ability to create more tokens in the future, and this can be audited in the smart contract. I'll give a few examples of this when I do a dedicated video on tokenomics, and I'll also explain the difference between a coin and a token, as I know that this can be confusing. Our last aspect to cover is the community. The community surrounding a given project is a vital aspect towards its success. Ideally, you want a savvy community who understands the industry, the project, the team, and the vision. You want a community that holds their coins even when the price drops. These are referred to as strong hands. If you have a community of weak hands, the price can drop a bit, and then some of them start to panic sell, causing the price to drop further, which can cause a cascading effect where the price goes off a cliff. Having a strong community shows that the founders and their team care about their investors and is putting in the effort to be open about their progress and the challenges. Over time, this creates a strong bond between the team and their investors, which leads to positive word of mouth, which pushes the project further towards success. You can get to know a project's community through their social media page, Discord, Telegram, Reddit, Slack, or wherever else people are openly discussing a particular project. Alright, congratulations on making it all the way to the end of this video. I know it's a lot in a short amount of time, but you stuck through it. So as a thank you, I'm going to share a few of the red flags that should make you seriously consider whether or not you want to invest in a project. Of course, as always, none of this is financial advice. I'm just another member of the community educating those who are new here so we can be smarter together. Some of these red flags are more serious than others, but it's up to you to decide what your risk tolerance is and how to proceed when you run into one of these. The first is an anonymous team. If you can't easily see who is on the team and on their website and their social media, it likely means they don't believe in their project enough to put their face on it, or they're outright trying to scam investors. Founders who believe in their project and its success are generally eager to put their name on it to build a reputation for themselves. The second red flag is if the use case doesn't need a blockchain. This goes back to what I said before. If they are a centralized company and are just building a blockchain that is unlikely to be censored, they would be better off using a centralized database. Centralized databases are far faster and easier to manage, and this is doubly true if they're just adding blockchain to their name to generate hype. On blockchain. The third one is if they have no active community or it's difficult to find their community. If you can't find a vibrant community who is excited about this project without being delusional about how it's going to change the world, this could be a red flag. It also depends on how early we are in the project's life. A strong community does take time to build. The fourth red flag is if they have a vague white paper or no roadmap. A white paper is a proof of concept that outlines their goal, how they will achieve it, and what their timeline is. If they can't state exactly how they plan to build it, then maybe they can't and are surviving more on hype than on anything else. The fifth red flag is if they have no GitHub activity. While the number of commits in GitHub isn't a strong indicator by itself, having no activity at all may be a red flag. Either they aren't making any progress, or the project is dead, or their code isn't open source. Open source code is generally much better because it allows the community to audit it and find vulnerabilities. If major vulnerabilities make it into the final product, you could have a fatal flaw that will only show up after it's too late to fix it. Now, there are reasons why they wouldn't want to open source all of their code. Maybe it's early on and they want to prevent competitors from copying it, but generally open source is much more secure and builds more trust. The sixth and last red flag, and probably the biggest one, is if any project says they guarantee you a specific return on investment. This is a massive red flag. These are often how Ponzi schemes trick new investors into buying into their scams. There are no guarantees in investing, period. You don't get a return without some level of risk. If you're not sure what I mean, look up BitConnect. BitConnect was a multi-billion-dollar crypto Ponzi scheme back in 2017. They promised risk-free annual returns of sometimes over 500%, and about 1.5 million people were scammed out of their money. don't fall into that trap. Well, I hope I've instilled the right amount of fear in you so that you're skeptical of projects that you hear about, but not so much that you just throw your hands up and say this whole industry is for scammers. Blockchain technology is truly revolutionary, and it will change how we manage money, trust, and more. But where there are people investing their money hoping for profits, there are inevitably those who want to take advantage of them. Use your common sense. If something is too good to be true, it probably is. As always, thank you for joining me. If you appreciate the information I've shared, be sure to click the like, subscribe, bell button, and help this channel grow. And if you know somebody who's interested in cryptocurrencies, send this video to them so that they can learn to avoid the traps set for new investors as well. I'm officially unemployed now, so I extra appreciate the support, and next week I'll share some details of more videos coming out per week and how you can contact me if you're interested in a more personal crypto education. Till then, thank you, and I'll see you again next week.